I'll let you know when you're ready. All right, you're live.
All right. All right, guys, welcome. So you can hear me, I'm going to take the mask off. This is Bagels and Business, and we have a great crowd here today because of the snow. But I think we have a lot of you online here, and thanks for joining. We have a great, just a great topic today. Pay the IRS less without going to jail. Now, before you get all worried about that, it's actually a business tax deduction workshop. This is all legal. This is all within the law. So there's no, it's how to minimize your taxes legally through the tax code. There's no tax fraud going on here. So just to let you know, okay? So, but Merrill Taylor is an expert. He's been practicing taxation for about 20 years. Yeah, about 20 years. Yeah, time flies, right, when you're having fun. So, and so I just want to tell you a little bit about the Small Business Development Center. We're one of the co-hosts, sponsors today. The Small Business Development Center, just go ahead and pick up a chair anywhere you'd like. And by the way, there's some bagels out there. You're walking, you can grab some bagels and drinks. There's water and some juices out there if you'd like. So the SBDC, or Small Business Development Center, we're part of the Salt Lake Regional Office located in this building. And we work with entrepreneurs, small business owners, all different types of industries. And you see how best we can help them work through different challenges, such as trying to prepare for a loan, investment, or work through marketing challenges, or even intellectual property. We're not patent attorneys, but we'll kind of help people as they strategize on their intellectual property approach. And if people, obviously, if they try to go deeper, we'll bring in and introduce them to some of those experts that can do that. Same thing with taxes and accounting and other areas. People have questions, and as they go deeper, we'll bring in experts who really do this day in and day out in those different functional areas. We have workshops like this one. In about a week and a half, we have the payroll tax workshop. And so it's a full day workshop if you have employees or if you're working with independent contractors. And that one is in person only because of the nature of it. We don't record that because things change. Some of the presenters don't want to be recorded. And so we're going to be working in the future trying to figure out how to make that a more online experience throughout this challenging times. But again, that's about a week and a half. We encourage you to, if you can, just go ahead and sign up for that and then come on down for that. Also, we have some other events and workshops that we have in the works, and so just if you're on our email list, then you'll be able to be kept apprised of those different events. So that's about the Small Business Development Center. Oh, by the way, so we have locations throughout the state of Utah, about 14 locations, and so you can, if you're in Salt Lake County or Davis County, San Pete County, all over the state, we have some representation of people you can reach out to for one-on-one advising. And so we do one-on-one advising as well as the workshops. We're funded by the SBA and the host college institutions, as well as Governor's Office of Economic Development. And I'm going to give a shout out to the Mill. So we're located right now in the Mill. It's a co-working space located at the Miller campus in Sandy, Utah. And it's the oldest, the original co-working space in Utah. Interestingly, it's been here about 15 years ago. So just a really cool opportunity. It's really inexpensive, and for people to have co-working space and even offices when they pop up and are open, or dedicated desks. So just a great opportunity. Again, my name is Bryce Hansen. I'm with the Small Business Development Center. I'm going to go ahead and introduce Merrill. So Merrill, in 20 years practicing tax. I worked with Merrill years ago when I first got out of college with my master's degree, and I was doing accounting work as an auditor, and he was on the tax side. So I was introduced to him, and I've been really one of the things that I like about Merrill is he really knows what he's talking about. He's dedicated. He works hard, a lot of long hours over the years, and so he's really an expert in the tax field for personal and for business. So I'm going to have Merrill come up and take over. So thanks, Chris.
All right, yeah, as Bryce said, my name is Merrill Taylor. I am a CPA, been practicing about 20 years, as Bryce said. So one thing I will say is there's a lot that goes into taxes and business taxes and that whole thing. And so I recently started a YouTube channel. It's youtube.com/tax-tutor. I put a lot of videos on there. So a lot of the stuff that we'll go through today, we have a short time, an hour, hour and a half. I go into more detail on all this stuff on that YouTube channel. And we do a new video every week with new things. And we record those in bulk. So I already have stuff to go out through middle of April that will be released. So that will be a constant. It's a good resource of information and things to go through. So, and I try to make things as simple to understand as possible because the tax code is incredibly complex. So, so as we go through this today, let me know if you have questions. It's meant to be kind of more interactive. So yeah, I mean, how that goes. And I guess if we get questions online, let me know
Yeah.
how those come through. All right, so
Is that clicker working?
it is not.
Is it on the side?
I think so.
I might be having an issue. I'll click through for you, sorry.
Oh, that's fine. Okay, so yeah, let's go to the next one there. Okay, so first off, I always start talking about entity selection because it's confusing the way that entities work and how they work for both legal as well as for tax purposes. So first off, we talk about the legal side of things. So you don't go to the IRS and set up an entity. You go to the state and set up an entity. And when you go down to the state to set up an entity, you have various options and choices of what type of entities you can have. LLC is the most popular. You can also set up a partnership. You can be legally a partnership, or you can be a corporation. Those are the three legal entities you can set up. You'll notice I didn't say sole proprietor because a sole proprietor isn't necessarily a legal entity. A sole proprietor is anybody who is just in business, anybody who starts getting paid for their services or getting paid for goods or getting paid for anything. A lot of people think you have to have an LLC to do business. You don't have to have an LLC. A lot of people think that having an LLC gets you a better tax result. It doesn't do anything for you for taxes. It helps you legally, but it doesn't do anything for you on the tax side necessarily. So you can be a sole proprietor. I always give the example of my sister when she was in high school, tutored for the family down the street. She was a sole proprietor. She was a business owner. She was a business operator at that point. She got paid for tutoring. She reported that on her tax returns. We reported expenses that she had, supplies or whatever she bought. She was in business. No LLC, nothing like that. She operated a business just like any other business operates out there. So those are your legal choices, LLC, partnership, or a corporation. When you go down to the state, a lot of people operate as an S corporation. There's no such thing as an S corporation legally. You can't go down to the state and say, I want to be an S corporation. You can set up a corporation with the state, and then you make an election to turn that corporation into an S corporation with the IRS. An S corporation is purely a tax designation and has nothing to do with the legal side. So let's talk about the tax side and how that works. So if you are a sole proprietor, what is the next slide? Was it? I think we go. Okay, yeah, you can go back to that. Okay, we'll stay on that one. So if you're a sole proprietor, then you're in business for yourself, and you could be a sole proprietor legally, even though there's no legal designation of sole proprietor. On the tax side, a sole proprietor just files a Schedule C on their personal tax return. A sole proprietor is them personally doing business as themselves. You can file taxes as a partnership. So if you go down to the state and set up legally as a partnership, then you would file a partnership tax return, which is a Form 1065. If you go down to the state and set up a corporation, then you would file Form 1120 as a corporation, as a C corporation, for tax purposes. If you make an election to turn your corporation into an S corporation, then you would file an S corporation tax return. So that's how it works for taxes. Now, you'll notice I didn't say anything about LLCs in that. LLCs are an interesting entity. They were invented by Wyoming back in 1978. So they are relatively new in terms of how entities work and how entities operate. So, they've been around, 43 years? I was born in 1979, so LLCs are 1 year older than I am. So And so when Wyoming invented them, the IRS took a look at it and they said, we have tax code for sole proprietors, we have tax code for partnerships, we have tax code for C corporations. Oh, that working? Not perfect, thanks. We have tax code for C corporations and we have tax codes for S corporations, but we don't have any tax codes for LLCs. So they had to think about it, and the IRS doesn't move quickly. It takes them a long time to figure things out. So it took them 10 years to figure out what to do with LLCs. So late 1970s, so now we're late 1980s, they finally came out and said, okay, this is what we're going to do with LLCs. If you have an LLC that's owned 100% by an individual, we're going to treat that as a sole proprietor under the tax laws. So that's why setting up an LLC doesn't do anything for you tax-wise, because having an LLC or not, you're going to be a sole proprietor, you're going to file a Schedule C, all the same. Having an LLC gives you legal protection in case somebody tries to sue you and come after your assets, but it doesn't really help you much on the tax side. It's all the same. So an LLC owned 100% by an individual is a single member LLC, or is a sole proprietor. Then they said, okay, if you have an LLC and it's owned by more than one person, we're going to treat you as a partnership. So an LLC owned by more than one person gets treated as a partnership, files Form 1065, and acts like a partnership for tax purposes. Then, for some reason, the IRS went further and said, oh, and if you want your LLC to be treated as a C corporation, then file an election and we'll treat your LLC as a C corporation. Or if you want it to be an S corporation, then file this other election and we'll treat you as an S corporation. So an LLC can be a sole proprietor, it can be a partnership, it can be a C corp, it can be an S corp, but it can't be itself. There's no such thing as an LLC tax return. Just because you have an LLC doesn't mean you say, oh, I have an LLC, what form does the IRS have for LLCs? There is no such form. You're either a Schedule C if you're a sole proprietor, you're a Form 1065 if you're a partnership, you're Form 1120 if you're a C corp, and you're Form 1120S if you're an S corporation. So whenever I have somebody come to me and say, I need help with taxes, and then say, okay, what type of entity? And they say LLC, well, then I have to start asking questions. Say, okay, do you own it 100% yourself? Do you have more than one owner? Have you made any elections to be a C corporation or an S corporation, so we can figure out how those are taxed? So, and I have clients that are LLCs that are taxed as all 4 of those. So, yeah.
Really quick question, you may go over this.
Yeah.
If it's a husband and wife that own it together and they joint file every year, is that considered a 1 member or a 2 member? Like, that'd be a partnership or a single member?
That depends on your state. So certain states have what are called community property laws. California is one of those states, and there's a handful of other states. A community property state means that they treat a husband and wife as 1 unit. So the IRS says if you live in a community property state and you have a husband and wife that own an LLC, you can treat that as kind of a sole proprietor or file that on your personal return. It's actually kind of interesting the way that it works in those states. Utah's not a community property state, by the way. But like in California, if you have a husband-wife LLC and you operate that, you could file, you would have to file 2 Schedule Cs. You'd have to split it, or you'd file a joint Schedule C. There's certain ways of doing that. But here in Utah, we're not a community, so if you're in a non-community property state, a husband-wife LLC is a partnership and files a partnership return.
Thank you.
You're welcome. Okay, so on these entities, so we have the sole proprietor. It's the simplest form of doing business. You get no liability protection because you have no legal entity in place, and you file Schedule C with Form 1040. A single member LLC, like we went over, is treated as a sole proprietor. You do have liability protection as a single member LLC, and you file that Schedule C. You can set up a limited partnership with the state, or you have an LLC with 2 or more owners. The nice thing about having a partnership is you can allocate income and expenses by partner. So, you can have a husband-wife LLC that's owned 50-50. You can have them own 80-20, 70-30. You can kind of come up with whatever ownership you like there. Yeah.
I came across in doing it by accident because we had partnership, and we filed as an LLP.
Uh-huh.
And that is different than an LLC because one partner is silent and then the other one has full liability.
Right.
So would they file your 1065 then?
Yep, yeah, that files a 1065. So an LLP is a limited liability partnership. The tricky part with that is you can either have a limited partnership like that, a limited liability partnership, or you can have a general partnership. With a general partnership, all of the partners take on personally the liability of that business. When you have a limited partnership, at least one partner has to take on the liability. One partner has to raise their hand and say, yeah, pick me, I'll take all the liability myself. When you have an LLC, none of the partners have to take on that liability.
Bad.
So that's why nobody sets up limited or general partnerships anymore, because who wants to take on the liability of the partnership? That's insane. So now everybody sets up LLCs and they have it owned by 2 more people. Everybody has limited liability on that. So yeah.
Someone online is just asking if they can get a copy of the slides after this.
Yeah,
How they do that?
Yeah, if we have their email, then I can send it over to them.
Okay, we can send them up. All right, and then yeah, partnerships file at Form 1065. S corporation. So the biggest difference between a partnership and a sole proprietor to an S corp. So a sole proprietor and partnership, everything that those entities make is subject to both income tax and employment taxes. So if your LLC, if your sole proprietor, your single member LLC makes $100,000 during the year, you pay income tax on that $100,000, and then you pay self-employment tax on that, which is an additional 15.3%. So you're paying $15,000, which is the same thing as an employee. So when you're an employee and you get a W-2, 7.65 of your paycheck goes to employment taxes, and your employer is required to pay the other 7.65. So you see 7.65 go out, the employer pays 7.65, it's 15.3% that's paid. When you are self-employed, you are both the employee and the employer, so you pay the full 15.3%. So a single member LLC or a partnership that makes $100,000, you're going to pay $15,000 of employment taxes on that $100,000 of income. It's not uncommon for us to see small business owners pay more in self-employment tax than they do in income tax. A lot of times they don't even pay any income tax, but they have this huge self-employment tax bill that comes along with it. When you have an S corporation is unique in that the tax code says that whatever an S corp makes is only subject to income tax and is not subject to employment taxes. So you can save a lot of tax, a lot of money being an S corporation. The downside of being an S corporation is that you have to file an S corporation tax return. So if you're a single member LLC, a sole proprietor, you file a very simple Schedule C on your 1040. It's a 1 to 2 page form. That's just income and expenses. That's basically all you have to report. Very, very simple. If you turn that sole proprietor into an S corporation, if it's a single member LLC and you make an election to be an S corporation, you now have to file a full S corporation return, which is a minimum of 5 to 7 pages, because you have a front page with income and expenses, you have several pages of questions that get asked, you have a balance sheet that gets reported, you've got AAA account, you've got all these complications that go into it. So it's a much more complicated filing. And when you are an S corporation, the IRS said, it's really not fair that S corporations don't pay any employment taxes, whereas all these other entities do. So when you're an S corporation, you are required to pay yourself a salary. You have to set yourself up on payroll and pay yourself and get a W-2 from your S corporation. So now you've got to file an S corp return and you've got to file payroll, do payroll tax filings. And those are all due quarterly, both on the federal and state level. So now you have quarterly filings that come to that as well. But if you look at the savings, let's say your S corporation makes $100,000 during the year, and that salary you pay yourself has to be reasonable, which the IRS defines as what you would pay somebody to do your job, or what you look at your duties and your functions and say, okay, what would you pay somebody to do what you're doing, basically? And let's say it makes $100,000 and your reasonable salary is more like $50,000. Well, you pay the employment taxes on the $50,000, which is only $7,500, rather than the whole $100,000, which was $15,000. So now you're saving yourself $7,500 a year in taxes, which can easily go to paying to have an S-corp return filed and pay your payroll and have plenty left over that you save quite a bit of money that way. Yeah.
But, okay, but in it, like you said, you pay 7.65 or whatever, and then the business pays 7.65, which is the 15.
Right.
Right?
Uh-huh.
So if that's the case, then are you not still paying the 17 or the 15, whether you're paying, because you're the person, right?
Right, yeah, so for an S corporation, you only pay employment taxes on the salary you pay yourself. So if the salary you pay yourself is $50,000, then you pay the employment taxes on the $50,000, the $7,500. That other $50,000 that the S corp made, you just take a distribution out of the S corp for that, or you leave it in the S corp. You're going to get taxed on it for income tax, but not for employment taxes. The other downside of that is when you cut your salary like that, when you don't have that much going into the Social Security system, when you go to retire, you will get less Social Security benefits at that point. Now, it can be argued that that $7,500, in that example that you save, if you put that into a retirement account each year, can you do better in retirement than the government does with your money? Probably. If you're smart about it, if you save it and you put it where it needs to be, you put it in an IRA, you put it in some kind of retirement account that's going to grow, and chances are you'll probably do better than the government does.
Hey, Merrill.
Yeah.
Is there kind of a general rule of thumb where you say kind of like as people make, because they might have an LLC, like partnership, and they're not very big, but then at a certain point, but it's a revenue generating kind of cash flow kind of business.
Mm-hmm.
Do you think there's kind of a threshold generally where you start looking at having an S corporation versus just a simple LLC in that case, right? So there might be a point where it's not worth, like if you're making $10,000 a year on your through an LLC, maybe it's not worth going through the extra S corporation status. But I mean, is there kind of something you guys look at?
Yeah, certainly. Yeah, there is. So we look at how much the business is making, because that's key, important to begin with. And then we look at what the reasonable salary would be for that S corp owner. So and it really kind of starts with that reasonable salary. So we say, okay, what would be a reasonable salary? And if that reasonable salary is $50,000 and the S corp is making $30,000, or the business is making $30,000, it doesn't make any sense to be an S corp. You're not going to have any benefit or any savings there. The threshold that we use is $10,000 above what the reasonable salary is. So if the reasonable salary is $50,000, you're going to want to see that business making $60,000 before you consider converting to an S corporation, because that $10,000 difference will save you $1,500 in employment taxes, and you can use that $1,500 to file the S corp return and do the salary, and it'll be about break even at that point, because it'll be about $1,500 to do an S corp return and do a salary and do the W-2s, and so that's usually the threshold.
And is that, and you're just clarify, that's when you're saying that's their net revenue after expenses, et cetera. So right?
Yep, yeah, that's their net income, right?
Yeah.
Good question. Yeah.
So Heather online is asking, can you take more deductions with an 1120 than with the Schedule C?
No, they're all the same.
They're all okay.
Yeah. I mean, yeah, an 1120, if you're a C corporation, you get a little bit better because you can do more benefits, like you can pay health insurance, there's more benefits you can take, but, and I'll get to C corporations now. The big downside, the huge downside, is a C corporation pays 2 levels of tax. So a C corporation, when you file an S corp return or a partnership return or your Schedule C, those returns, there's no tax due. So you file an S corp return, it says, okay, you made $100,000 during the year, here's your K1 for $100,000. In the S corp, there is no tax due on the S corp return. When you file a C corporation return, that has tax due. Right now, the tax rate is a flat 21%. So if your C corporation makes $100,000 of income, $21,000 goes to the IRS. It's tax that's due. And then you have a remaining $79,000 that you can distribute to yourself. And when you distribute that to yourself, it's considered a dividend and it's income to you, and you pay tax on that. you pay 2 levels of tax. I have a whole video on this on the YouTube channel comparing the entity choices. C corporation is a terrible way to. There are instances and reasons to have a C corporation, but a general business that's operating and running, it's a terribly tax inefficient way. You get good liability protection with a C corporation, and then those file Form 1120. So yeah, I mean the only real difference is you can get better benefits, but I'd say that the taxes you pay far outweigh the benefits that you can get from it. And there's other ways to get benefits as well. So other ways to get those taken care of. Okay, business records. So business records should be separate from the non-business. Kind of just basic that you want to keep those two separate. You want to open a bank account to use for all the business transactions, and you want to avoid cash transactions where you can. The problem with cash transactions is the IRS is really leery of those. They're really suspect of those. So anytime you have an IRS audit and you're showing that you're transacting a lot of things in cash, they immediately wonder, did they get cash that was never reported on a tax return? That turns the IRS audit into what's called a lifestyle audit. So they look at it and they say, this person makes $50,000 a year, but they live in $1 million house. Something's not adding up right here, right? And so it's called a lifestyle audit that they go through. You don't want to pay any non-business expenditures from the business account. So what that means is using your business account to pay your personal expenses. That's called commingling of funds. It can, on the legal side, I'm not an attorney, but on the legal side, my understanding is that if you go to court, if somebody sues you, your business, and you say, I have an LLC, I'm protected, I have liability protection, they'll say, oh, but you paid personal expenses from your business account. You didn't treat this like a business, you treated it like your personal, and it's called like piercing the corporate veil. So that could be a problem there. You can always pay business expenditures from a personal account and have your business reimburse you, but you want to be really careful about paying personal expenses from a business. Only charge business expenses to a business credit card. Use personal credit card for non-business expenditures, and funds can be transferred between the personal and business accounts as needed. So if you have your business has a lot of money in there, then you need to pay personal expenses, you transfer it to your personal account and pay your expenses there. If your business gets low on funds, you can loan the money from you personally, or you can make a capital contribution in. Those work really well too. The biggest reason for having business records separate from non-business records is if you get audited by the IRS, it turns into an absolute nightmare. I had a client that this happened to. Before they were a client, somebody had prepared some tax returns for them. Then they became a client, and then those tax returns got audited by the IRS. So we had to go through an audit of somebody else's tax return. And this person had a Schedule C. They ran a construction business out of their Schedule C. They didn't have a separate business bank account. They ran everything out of their personal account. And as what happens in an IRS audit is they ask for your bank statements, your bank records. You give them your bank records. They take those bank records and they total up every single deposit that went into your bank account. They then compare those deposits to the amount of income reported on your tax return. And if you have more deposits in your bank account than you have income on a tax return, you have to explain why, because the IRS automatically says, they'll add that money to your tax return and tax you on it. And so in this case, it was his personal account, and he had all sorts of stuff in there personally. So we had to go through, and there was a $20 deposit in there. And he said, oh, you know what? This guy was in his 40s, 50s at the time. He's like, oh, you know what? My sweet grandmother to this day still sends me $20 for my birthday every year. That was my birthday money from my grandmother. Then there was another $15 deposit. And they said, oh, you know what? We went to the movies with some friends. We paid for the tickets. Our friends reimbursed us. That was our friends reimbursing us for tickets. So you have to get into that kind of level. Otherwise, that would have been, $35 that would have been taxable income to him had they not gone into that level to explain. So that's why you want to keep your business and personal records separate. Otherwise, you'd have to explain your personal life to the IRS in an IRS audit, which is kind of painful. Documentation. So documentation is the key to being able to minimize your taxable income. If you don't document something, then you have no way of being able to deduct it. So it goes back to that cash side. Getting cash income is tough because you have to prove to the IRS that you reported all that cash income, but it's also difficult to prove to the IRS the cash expenses you have. It's also difficult to keep track of those cash expenses. I think of my dad, who's terrible with money. You give the guy $100 at the beginning of the day, at the end of the day, it's completely gone, and he couldn't tell you where a penny of it went. And so in that case, there's no documentation. There's nothing, was it spent on business? Was it spent on personal? What happened? Where did it go? So being able to document things is helpful, getting receipts and things like that, yeah.
Now people are not getting receipts because it's done, should you always ask for receipts and keep those receipts and that, or they're like, but it's on my statements, so I'll just go off the statements.
Yeah, so the tricky part with that is, let's say you go into Walmart, right? You go into Walmart, you can buy anything in Walmart. You can buy business supplies, you can buy groceries. And so the problem that you have is if you have your statement, a credit card statement or a bank statement and says, I went to Walmart and spent $300 on stuff and it was all business, the IRS is going to look at that and say, what did you buy? What is here? We can't document that. We don't know if this was grocery, your weekly grocery bill, or if it was boxes for shipping for your clients or something like that. So the IRS, I want to say, is pretty antiquated in the way, but also there really is no other way of doing it. They like paper receipts. They like to see the receipt. So for me, anytime I pay for something that's a business expense, I always get a receipt, bring it back to the office, and put it in a drawer, so I always have it. The worst IRS audits I've ever been through were people that had no documentation. I've been through IRS audits that have lasted an entire year and cost $10,000 plus because there was no documentation, there was no receipts. The IRS asked for mileage logs. They produced 2 different mileage logs that had different numbers. It was an absolute nightmare. They didn't keep their bank records. They had to go to the bank and request those. IRS audits happen generally 2 to 3 years after the tax years, after that year. And so you have to go to the bank. The bank doesn't keep those records, so they had to charge them extra. They had to go down to a vault. They had to copy them. I mean, it just took forever. It was a year-long process because they had no documentation. I compare that to an attorney who got audited by the IRS. And we walked into that IRS audit, and the attorney took a binder, and the IRS gives you what's called an IDR, a document request form that says, here's all the stuff we want to see. He took that IDR and he put it in the front of this binder, and then he put separate tabs for every item on the IDR. He had a summary sheet of what was deducted. He had receipts behind that, the whole thing. We walked into that IRS audit, and that IRS audit was done by lunchtime. No changes, no adjustments, nothing. The IRS auditor felt very comfortable with what was going on there. Versus the other one where the IRS auditor was like, this is a mess. There's got to be something wrong here. So the more information you can give the IRS, the more paper you can throw at them and say, here's this, the more comfortable they get with like, okay, this person knows what's going on. It's the IRS auditor's job, as bad as it is to say, to get money for the government, to get adjustments. And if they walk into something and they say, they had all their receipts, they had everything done, there wasn't anything, they're going to move on to the next guy who's a disaster. So that's helpful.
So you probably have it in your slides, but how long should you keep your records?
Generally,
how long can they go back?
What's that?
How long can they go back?
So yeah, the statute, I don't think I have a slide on this, but the statute of limitations is generally 3 years. Now that's 3 years after you filed a tax return. So right now we're filing 2020 tax returns, right, in 2021. So the IRS can audit your 2020 tax year, 1, 2, 3, all the way up until 2024. And so generally you'd look back. So right now we're in 2021, so 17, 18, 19, 20. So 17 was filed in 2018. So right now the IRS audit window is closing on 2017. Now, if they can prove that you understated your income during that year, then that window goes to 5 years. If they can prove that you did fraud on your return, that window never closes. It's always open. Now, I've never seen them push the window to 5 years. I've never seen them push it to 7. Now, it is common that they'll audit you mean, the IRS takes forever to do stuff. So they'll usually start auditing 2018 right now. And so the 2018 window will start closing next year. And so, maybe even later this year, they'll start auditing 2018. And then they'll ask for what's called a statute extension, where you agree to extend the statute, and it turned into a little bit of a mess that way. But 5 years is probably safe. 7 years is like the really, really safe answer. 3 years is kind of cutting it, because the IRS could still come back on that. But I'd say anywhere between 5 to 7 years is probably good to hold on to things. And it depends on those records too, because let's say you buy stock, right? And you bought stock 10 years ago that you're now selling. You have to be able to prove what your basis in that stock was. So you probably have to keep certain records like stock purchases for the length that you own that stock, whether it's 10 years. Same thing with property that you own, things like that. So there could be reasons to keep those records longer.
A few questions online if you have.
Yeah.
That's all right. So somebody wants to, can you talk about expenses that overlap between personal and business and how you determine what counts as eligible deductions? They're talking about office as a home, internet service, rent, like what?
Yeah, we'll get into home offices, but yeah, basically, whenever you have an expense that can be both personal and business, so cars fall into that. Home office, and you can see that we have some of those. So we'll say special record keeping for auto, bills, entertainment, travel, payroll. We'll get into the home office, but there's a way that you have to separate those out. So we'll get into those.
And then there's one more question about keeping paper documentation. If they have a really good accounting system they're using, should they still keep the paper receipts and documentation?
Yeah, and I go back and forth. I mean, the IRS is more comfortable with the paper. They're really antiquated that way. I mean, you got to think about, the IRS still uses fax machines.
Okay.
And their computer systems are really, I mean, they are very, very old school. They're not up to date at all. You could scan those in, but you deal with the IRS auditor starting to wonder if they've been doctored. I mean, the IRS auditor comes with, they just think everything's bad. And that's their job, is to think everything's bad. And they're constantly trying to think, how could this have been changed? How could this have been falsified? And they're just they just have that. I mean, it's a terrible way to live, but it's the way that they live, right? And so, but physical receipts can cause a problem too, right? When you get a physical receipt, those fade over time. They disappear. So, I mean, the best system would be to scan them in and have them electronically, but then also have the physical receipts as well, just to be safe. I mean, you could scan it. It depends on the IRS auditor. Some are more difficult than others, but for me, I just throw them all in a drawer and hope they last. If I ever get audited by the IRS, I should scan them in and have duplicate that way. Would be the safest. But okay, so generally any system that shows income and expenses is acceptable when we're talking about accounting. So a lot of people will use QuickBooks. QuickBooks shows income and expenses. Sometimes QuickBooks is overkill for what a business might be if you just have a few transactions a year. Like if you run a rental property or something like that, and all you have is income and a few expenses, QuickBooks might be overkill. So in cases like that, I advise clients to set up a separate bank account, always have a separate bank account. And then at the end of every month or quarter or year, however frequently they want, the more frequently the better, you log into your bank account and you download your transactions into an Excel file. And then you take that Excel file and in one of the columns, you categorize what that item is, whether it was rent income, if it was a rent property or business income, or what type of expense, office expense, cell phone, whatever type of expense it was. And then you can sort by that category, or you put formulas in there to sum up those category type things. And that's basically what all QuickBooks is doing. If you use QuickBooks, you download your bank transactions into QuickBooks, and then you categorize those transactions. Same thing that you can do in Excel. You download everything into Excel, categorize those transactions. It's the same thing. QuickBooks obviously is a little nicer. It'll generate income statement, balance sheet, and a number of things that way. But you can get there the same way with an Excel file as well. And then special record keeping rules required for auto, meals, entertainment, travel, and payroll. We'll go through this here. So I like to talk about what a deductible expense is, because it always comes up. The question is, what can I deduct on my tax returns? And the answer is, it's different for every type of business. So a deductible expense is an expense that is both ordinary and necessary. So ordinary is common and accepted in a particular industry, and necessary is something that's helpful and appropriate for a particular trade or business, even if not indispensable. Which basically means, you can think of having a business license. A business license is required and necessary to operate your business. That's an expense, easy business expense, right? Advertising, marketing, you don't have to advertise marketing. It's helpful, it grows your business, but you don't have to do it. So that's one that's kind of a dispensable expense that you can have. It's not necessarily required, but it does help your business to grow and develop. I always give two examples when talking about this. So I was in an IRS audit. It was a auto repair shop, and they went to Walmart, bought some stuff. IRS said, show us the receipt. What did you buy? I gave them the receipt, and it had kitty litter on there. And they said, kitty litter? That's not a business expense. That's obviously personal. We're disallowing that. And so we talked to the client, said they didn't like your kitty litter. And they said, well, we're an auto repair shop, and we drop oil on the ground, and kitty litter is great at soaking up oil, so we use that to soak up oil. So back to the IRS, explained it as oh, okay, that makes sense. That's fine. I'm a CPA. Can I buy kitty litter? No, I don't have oil all over my floor. Nobody would come to my office and take me seriously, right? So for me, kitty litter is not a deductible business expense, but it is deductible for an auto repair shop. Another example is the IRS came, I was in the IRS offices downtown Salt Lake, and there was an audit manager who was talking really loud. He said, hey, I went in and I was auditing this person, and they were doing construction industry, and they had bought a gun and deducted it as a business expense. And I told them, no way that's a business expense, and we were going to disallow it. And the guy says, well, wait a minute. I'm in the construction industry. I go to construction sites early in the morning. Sometimes people move into the structures we're building, and they're not always the brightest and happiest people first thing in the morning. So this gun is for my personal protection on the job site. And this IRS audit manager agreed with them and allowed the deduction. Now, I wouldn't say every IRS audit manager would do that, but in this case, that happened. Again, could I buy a gun in my CPA firm? Probably not, unless I was being threatened or something for messing up somebody's tax returns. But to this day, probably not. I'm not under threat from anybody that I know of. So that's why it's difficult to have like a whole list of here's what you can deduct in your business, because every business has different deductions. So we rely more on the definition of what's deductible rather than just a list of things. So non-business expenses are charitable contributions. If you have an SCorp or a partnership or a sole proprietor, and you do a charitable contribution in those, like let's take the example of an S corporation. You own an S corporation. Your S corporation makes a charitable contribution. That goes on a line on Schedule K, which is on page 4 of the 1120S, I believe. And then that shows up on a special line on your K1. That special line on your K1, and K1 is what you get from an S Corp that says, here's your income from the S corporation, report this on your tax return. So you take that K1 and it'll have box 1 that shows your ordinary income, and then down that row, there's another box that shows this charitable contribution. And what happens with that charitable contribution is it ends up as an itemized deduction on your personal return. So if your business makes a charitable contribution of $500 and you think, oh, that's great, I'm going to get this great deduction, and then it flows into your personal return and you don't itemize deductions, you're going to get no benefit for that. So here it says consider advertising. So if it's, like a couple of years ago, we donated a Walk for Life or something like that. Our name was put on the t-shirts, our name was put in the advertising, was put in all that sort of stuff. It was a charitable organization, but because of our donation to them, our name was put on their marketing materials and things like that. Our name got out into the general public, and it turned it into an advertising expense rather than a charitable contribution expense. So it was an ordinary business deduction rather than becoming an itemized deduction on a personal return. Penalties and fines are not deductible. So if you're speeding to a business meeting and get a ticket, that's not deductible. Political contributions, lobbying expenses, those are not deductible either for business or even for personal. And then the owner's health insurance is not deductible as a business expense. You can put that on your 1040 as a self-employed health insurance expense is what goes on there. So, and S corporations require a certain reporting that is needlessly complicated. But the way that it works for an S corporation is the S corporation actually takes a deduction for the health insurance, but it gets added into your W-2. So your W-2 is increased for health insurance, the business income is decreased. So when you get to your personal return, your W-2 line is increased for health insurance, your 1040 line or your K1 line is decreased by it. So you end up with a net zero, and then you have to add it to the self-employed health insurance line to get a deduction. I don't know why the IRS does it that way, but that's the way it works. Yeah.
The health insurance is a private insurance, not a Medicare, not a, they deduct automatically from your payroll, am I right?
Yeah, generally it can be, yeah. If you run a business, there is a way to claim your Medicare premiums as self-employed health insurance. But generally, yeah, it's generally private insurance that you have there. Yeah.
Thank you.
Okay, auto expenses. So this is one of those areas that it can be both a personal expense as well as a business expense. So how do we determine how to deduct auto expenses? So autos are considered by the IRS what's called listed property. Listed property is something you use personally as well as for business. So for an auto, the deduction is based on mileage, and the deduction may be disallowed without mileage records. So you always have to keep mileage for your vehicle, because that is how you prove to the IRS what your business use of that vehicle is. Even if you depreciate the vehicle or take your actual, because there's two ways to deduct auto expenses. We'll get into them. That you can deduct the mileage or you can deduct the actual. Actual is your depreciation and your oil changes, maintenance, and all that sort of stuff. Either method, you're going to have to prove your business percentage use, and that is proved through keeping a mileage log, a mileage record. So the taxpayer's mileage record should report commuting miles, business miles, and non-business miles. So if you don't have a home office, commuting miles is considered a personal expense. So when I go from my house in Sandy that I don't have a home office to my office in South Jordan, even though I'm going to work and I'm self-employed and all that other sort of stuff, that's considered a personal trip rather than a business trip. So you keep track of those three. And in this case, we had our business miles were 20,000. So they use this car 80% for business, which means they can deduct those 20,000 miles times the mileage rate and get a deduction, or they can take 80% of their expenses for that vehicle and deduct those as a business expense. We have some examples here. Okay, so two methods to compute auto expenses. We have actual costs. So actual costs includes gas, oil, insurance, repairs, lease payments, your car registration, and depreciation. And so we have an example here where we say, okay, our actual costs are $12,000. We times that by 80% business use, and in this instance, it equals a $9,600 tax deduction. We can also look at the standard mileage rate, which is 57.5 cents per mile for 2020. If you're filing your tax returns for last year, or for this year, 2021, it's 56 cents per mile. It's gone down a little bit because gas cost has gone down. So that always kind of goes up and down based on the price of gas for the year. So you can see here the difference between 20,000 business miles times that by 57.5 cents. For 2019, it was $11,500 deduction. For 2020, it's an $11,200 deduction. So that deduction went down by $300 between the 2 years because the mileage rate went down. And you can see in this example that the standard mileage rate was greater than the actual deduction. So you always have to run a calculation which I have a horrendous spreadsheet that goes through that. And this breaks all sorts of PowerPoint rules, being too small, being too complicated. This is just a spreadsheet that I put up there that shows mileage versus actual calculation. And you can see here that we took business mileage, we started out with 8,000 and went up to 35,000 during the year. And then we took the personal mileage from 2,000 to 8750 just to keep the business percentage the same. So this is an 80% business use vehicle. We took a mileage rate of 58 cents. And then that was our mileage deduction, is that next row between 4640 and 20,300. And then we did a calculation based on the actual. And you can see down below that when we had business mileage of 8 or 10,000, it was better to take the actual. But when the business mileage went up to 15,000 or above, then it was better to take the mileage deduction. And this goes through the entire life of the car. So we're assuming that this car is owned for 8 years, and the mileage is constant for the 8 years, and the expenses are constant for 8 years. So it just goes through all of those to figure out which is the better method to take. Because the challenge with mileage is once you use the actual method on a tax return, you cannot switch back and use the mileage method. So a lot of people think, oh, I know how we're going to do this. We're going to, oh, you're fine. We'll take the depreciation. We'll depreciate the whole car the first year using bonus depreciation or something else, and then we'll switch to the mileage method. So that doesn't work. Once you take a depreciation, you're stuck taking depreciation. So a lot of times people will get a big benefit 1 year for taking depreciation, and then they get a smaller benefit the following years because they're not able to depreciate that car and they can't go back and use mileage. So it's just important to look at how many miles you're going to drive over the years and see what that deduction equals based on mileage versus the actual expenses that you'll have over the years. And parking, tolls, and loan interest may also be deducted when using the standard mileage rate. And a mileage log is not sufficient if the entries are too generalized or not supported by other corroborating evidence. And that kind of a big word, corroborating evidence. But basically, it says that those records must support amount, time, place, business purpose, and business relationship. So what that means is you get audited by the IRS, you give them a mileage log. It says, here's all the miles I drove during the year, all the places I went, all the business type of stuff. Here's my odometer readings for those days, because that's what the IRS wants to see. They want to see your odometer, they want to see where you went, they want to see why you went there, all that sort of stuff. So you give them that information, and then they say, oh, hey, that's great. Can you give us your oil change receipts for the year? You say, oh, okay. So you give them the oil change receipts for the year. And then what does an oil change receipt have on it? It has your mileage. Yeah, it has the date that you went in. It has your mileage. And so they take that and they say, oh, on this date, you went in and had your oil changed, and they showed your mileage as 50,300, but your mileage log shows 60,500. Why is there a difference? And so they start to put together these pieces of what's going on. Another reason why you kind of keep those physical receipts, because they want to see that sort of stuff.
Someone online is asking if they have, I think they're asking if they have 2 different vehicles, can they do their deductions separately for 2 different vehicles? Like, can they do one for depreciation and one for mileage?
Yeah, that's fine.
Okay.
Yeah, it's a vehicle by vehicle type thing. So if you have one vehicle, and it's always still based on the percentage of business use. And it's important to note that if your vehicle is used less than 50% for business, you cannot depreciate it. It has to be used more than 50% for business to be able to be depreciated. Yeah.
You probably already asked, but can you use the app MileIQ if they accept them? I'd like that. Yeah,
that app is really, and the last slide kind of talks about apps that we use. MileIQ's on there. I use one called TripLog. They're very helpful. I was in an IRS audit once where they provided them on an Excel. This was the IRS audit that took an entire year, and they had 2 different, it was a nightmare. But that IRS auditor was being difficult and said, they gave him one in Excel and said, here's all of our stuff. And he said, no, I don't want it in Excel. I want to see it written down, different handwritings and different pins to see you kept it during the year, which is a completely unreasonable standard. But those apps are really good. So the trip log one I use, and I think MileIQ works the same way. When I get in my car and the Bluetooth turns on, that app turns on and GPS tracks everywhere I go. I have a constant log. You know, if anybody ever wanted to know where I was at, they pull up that app and they can see exactly where I was at, what time, and the whole thing. So I haven't been in an IRS audit in a while, ever since this technology came. I imagine they would accept that. I would be surprised if they did it, but again, we're kind of dealing with, that's all I keep. I don't keep it, I'm not going to keep a written log. That's silly. The written log is going to be far less accurate than GPS tracking everywhere I go every time I get in my car.
Who's handling the GPS record?
Who's handling that?
Yeah, you just mentioned that you can go back, track on it.
Yeah, that's kept inside the app, and then it also syncs with online. So the company that owns that app, the MileIQ, the trip log, they're the ones that they're keeping those records and things. So, but I can pull it up on my phone anytime and see those things.
And the last one, the business relationship. Exactly what you mean.
So that is if you go to lunch with somebody, as an example, and you get a receipt for that lunch, you want that mileage log to show that what your business relationship was to the people you went to lunch with. So they're going to say, okay, was this a personal lunch and you went to lunch with family, or was it a business lunch because you went to lunch with a customer? So that's your business relationship, who you went to lunch with.
Thank you.
Okay, meals and entertainment. So meals are deductible if incurred while traveling on business or while dining with a client, customer, or employee. There is a 50% limitation on meal expenses for 2020 and earlier tax years. There's a special exception for 2021 and 2022. Meals from a restaurant are 100% deductible, which is the first time I've ever seen that happen in my career. I think the 50% limitation came in the 90s with Clinton, I believe. And so that limitation has been around for a long, long time. But with COVID and coronavirus and restaurant industry getting hit particularly hard, they said, hey, we want to give a special benefit to restaurants. That's how they run policy in the United States, is if they want to rebalance something, then they give a tax benefit for it for some reason, like stimulus payments and all that other sort of stuff. So they said, if you get a meal from a restaurant, it's 100% deductible for this year and next year to try to get people going to restaurants.
Wow.
Yeah, it's nice. So, records should support deductibility rules. So active conduct of business directly before, during, or after with a reasonable expectation of getting business. Taxpayer must be present. You can't send clients without you. You can't tell somebody, hey, go to lunch and I'll pay for it. Cost of non-business individuals is non-deductible. So if you have families there with kids and things like that.
Can you buy gift cards to restaurants as advertising for clients? You put it under advertising.
Yeah. I mean, you kind of run into, is it advertising or is it a gift? And gifts are limited to a $25 per person deduction per year, which is ridiculous. But yeah, like a marketing or advertising makes more sense in that sort of way. Yeah. This says no lavish or extravagant meals and entertainment. The IRS has no standard for that. It's just one of those things. We'll know it's lavish or extravagant when we see it. And so it's just one of those random things that somehow got put into the tax code. But yeah. And then beginning 1/1/18, entertainment expenses are no longer deductible. So if you take a client golfing or to the jazz game or things like that, you can run it through the business. It can be a business expense and show up on your P&L as an expense. It's just when we get to the tax return, we can't deduct it as an expense. Yeah.
Meals for restaurant 100% deductible. That means after 2020, so 2023, we're back to 50. Or they haven't decided.
Yeah, 2023, it'll probably go back to 50. At this point, it goes back to 50. Who knows? We've got a new administration, and let's see what kind of tax laws they come up with. It's going to be. We're going to have a big tax bill, or a big tax law change in the next year for sure.
Thank you.
There's no way taxes stay as they are. That other side was not happy with what the other side. So, yeah, there's going to be some changes. This is another horrendous schedule. Guide to meal and entertainment deductions. So this was, I put 2020 on there, but I did add a line item down at the bottom that says meals provided by a restaurant are 100%. So that's really the 2021, 2022 law. But generally, this was the way that it works. So you can see our 0 column over to the right, entertainment with clients and prospects, year-end party for your customers, golf, theater, football game for your customer, 0% deductible. Then at 50%, we had meals with clients and prospects, employee meals for the convenience of the employer. So that's you providing meals on your business premises for your convenience to keep your employees there and working. We run into this in the accounting industry a lot. We need our employees there working, and so we'll provide dinner and things for them. Employee meals required for a business meeting, meals served at a chamber of commerce, meals while traveling away from home, 50%. But for this year and next year, if those are provided by a restaurant, then those jump into the 100%. And then always 100% deductible are year-end party for your employees and spouses, which is different for your customers. Your customers is 0 because it's considered entertainment. But if you're doing it for employees and spouses, now it's considered kind of goodwill, employee, goodwill type generation. You can do golf outings, so you can do entertainment for your employees and spouses. And again, it falls under the employee goodwill type column. Meals for the general public at marketing presentations. So if you ever get a thing in the mail that says, hey, I'm a financial planner, come down to the Chuckarama, have a meal and listen to my presentation. Those are all 100% deductible.
Don't go to that
Yeah, wherever they have. Team building, recreational event for your employees, 100%, and then meals provided by a restaurant for this year and next. All right. Okay, so we had a question on business use of home. So a home can be used personally, it can be used for business. So how do we take that deduction? So there's 4 tests that must be met to qualify to deduct the business portion of your home expenses. Number 1, it's an exclusive use test. So it's the area has to be used exclusively for business. And I'll say if you get audited, now a lot of people think that having a home office deduction gets you audited by the IRS. I've taken that deduction tons and tons of times on tax returns and never could identify that it was the home office that ever got an audit. I used to work downtown for a really large firm that had thousands of clients, and they always had an IRS audit going on at all times, it seemed. So I dealt with a lot of IRS audits. I left that firm and started my own firm 6 years ago with 2 partners. And in the 6 years we've been running our firm, none of us have seen a full-blown IRS audit to go through any of this stuff. And we take home office deductions all the time. So it's kind of a myth that leads to an IRS audit. However, if your return gets audited and you have a home office deduction on it, you can be guaranteed the IRS will want to come and see your home office. The one audit I went through that took the year, that was just the nightmare one, he had a home office. He had a whole bunch of stuff on his tax return, but he did have a home office, but he was a recording person. He's actually on KSL radio, and he has a full-blown recording studio in his basement that we were deducting as a home office, because what else is he going to go do in there? Nothing really personal. So the IRS wanted to see it, so we went to his home, went down to the basement, went to a tour of his home studio, and it was a full-blown home studio that was down there. It was a valid business deduction. He wasn't going to use it for personal purposes. So you want to be careful if you're deducting a room as a home office and you have a guest bed in there, or you have kids' toys in there, or you have something personal in there, because that, even if you have a guest bed in there and you have a family member that comes and stays with you once a year, technically that turns that space into personal and not a business. So it just needs to be a space that's used exclusively for business. Regular use test, it must be used regularly. It can't be, the room in the basement, like, oh yeah, that's my home office, we don't ever go down there. You got to actually use it. Trade or business use test, you must be running a business out of it, a profit-seeking activity. Some people will have like hobbies, and so it can't be like a hobby. It has to be something that you're actually working to make money from. And principal place of business test. So you want to keep a log, so it's determined by the significance of activities performed and time at each location.
And what kind of things would you put on this activity log?
Just when you use it and what you did during that time.
I mean, I'm in there 8 hours a day working on 3 different companies.
Yeah, and some are easier to prove than others. Like if that's your only place to do business, that becomes real easy. Like for me, let's say, my son moves out next year, and I turn his room in the basement into a home office, but I still have my other office. And so in that sort of instance, the IRS is going to say, why do you have a home office when you have another office? Don't you go to the other office and work? But the IRS does allow for an administrative home office. So if I used my office, my regular office, for only meeting with clients, doing tax returns, doing my normal activities, then that is fine there. And then if I have an administrative home office in my home, where I open my mail, I do my accounting, I do the administrative side of my job, then that makes it a viable home office. But in that instance, I'm going to have a log that says, okay, here's when I was in my home office, here's what I did. When all you have is a home office, it becomes pretty obvious what you're doing and working there. So, yeah.
Must be related to profit-seeking activities. Nowadays, everybody stay at home, work at home. Is that under that category, profit-seeking activities?
Yeah, as long as you're running a business that you're looking to make money, make a profit from, then that works, yeah.
And the last one said that you have activity performed the time, so you need to keep a log.
Yeah, you want to keep a log just of what you did in your home office and the times that you're there and working, right? Yeah.
And you use your calendar as your, basically, because it says, you've got your appointments or whatever.
Oh, yeah. Yeah, that should work as well. Okay, so there's 2 ways to deduct a home office. There's a $5 per square foot. So a few years ago, they came out with what's called the standard deduction for home offices. And it's really, really simple. You just measure your square foot of what you're using for business. So in this case, we have an example of 300 or up to 300 square feet. So in this example, you have 150 square feet that's used for business. You times that by $5, you get a $750 deduction on your return. Very, very simple. You can also use your actual home expenses times the ratio of the business use over the total area. So again, we took 150 square feet used for business. The total home is 2,000 square feet, so we're using 7.5% of it for business use. And then you times that by your actual expenses. So your home expenses could include rent if you rent, interest if you're buying it, your home, your mortgage interest, property taxes, utilities, HOA fees, repairs, maintenance, depreciation, all that stuff can go into that. Times, so if those are total 20,000, times that by 7.5%, then you get a $1,500 deduction there. Now, when you depreciate a home for business purposes, it turns that portion into a business asset. So when you go to sell your home, technically you're supposed to recapture the depreciation you took. So you could have some income and tax due on the sale of your home for depreciating it. So that's just something to keep in mind. Most people don't pay much attention to that, but it is a rule that's out there for home offices. Yeah.
One time, I believe the IRS allowed people to deduct a percentage of their house. That also includes the yard work or not, or just the physical brick and mortar area.
Yeah, you could do yard work based on the percentage because if you have clients that are coming to your home, you need to have your yard looking nice for that sort of thing. So you just times that by the business percentage, the 7.5%. Yeah.
Thank you.
And there could be things that are in there that you could do 100% to. So if you have a home office and you buy a desk and furniture and things to go inside that home office, obviously those are 100% business use, so you wouldn't take those by the 7.5%. If you did something special in that room, painted it in a special way, or renovated that room particularly, then 100% of those costs could also be included in the home office. Okay, so QBID is our qualified business income deduction. So this was a special deduction that came about, started in 2018. This was part of the Tax Cuts and Jobs Act back in 2017. So back then, the corporate tax rate was cut, the C corporation tax rate was cut from 35% down to 21%. And so the small business owners the country and the nation said, well, doesn't seem fair. They get a tax cut and we don't. So the Congress came up with this qualified business income deduction, and it allows for a 20% deduction based on the business income. So if your business made $100,000, you could qualify for this $20,000 deduction, and you effectively only pay tax on $80,000 of income. This is for income tax only. You'd still, if this was a sole proprietor Schedule C making $100,000, you'd still pay self-employment tax on the full $100,000, but you'd only pay income tax on the $80,000. And it applies to all business owners with taxable income less than $315,000 for married filing jointly, or $157,500 for single. And it starts to phase out between $329,800 and $429,000 for married filing jointly. These numbers go up every year with inflation. And then only certain taxpayers can take the deduction with taxable income greater than $430,000 for a married filing joint return, or $215,000 for a single return. It's a really good deduction. So anybody that's under those thresholds, like the $330 for a married filing joint and the $165 for a single, anybody can get that deduction. Once you get between the phase out limits, you start to have to look at how much wages the company pays and how much property it owns. And when you go over the $430 and $215, then it gets really complicated. We get into bad businesses that aren't allowed to take this at all. I have a lot of doctors. So for some reason, they said certain professions are not entitled to this if they're making over those upper limits. And those are professionals: accountants, doctors, attorneys, consultants, celebrities, anybody whose name and reputation brings in the income, things like that. They lose it completely. So all of my doctor clients get none of this because they make way more than that, and they're not entitled to that deduction, unfortunately, which is tough for them right now because they're the ones that are working the hardest. But if you are in an industry that can take the deduction, it becomes dependent upon how much wages you pay and how much property you own. So it gets complicated. If you're under those amounts, then life's pretty simple and easy, but however, it gets complicated. Estimated tax payments. So depending on your tax situation, estimated tax payments may be required. The payments are due April 15th, June 15th, September 15th, and January 15th of each year. And payments are calculated based on your prior year taxes or your current year taxes, depending on whether income is increasing or decreasing. So an example of that is, I always use an example of this guy that I worked with. His company went public one year, and his income went from, he was like a CEO, right? His income went from $1 million from his W-2 to $40 million when the company went public. It was a huge increase. And in that instance, you use the prior year, say, okay, prior year, I made $1 million, my tax was $300,000 on that. And so as long as we paid in the $300,000, he was penalty proof, even though when we filed his $40 million tax return and he owed $10 million or whatever the number was, it was huge, more than people make in their entire lifetimes. He was penalty proof because he had paid in what his prior year tax was, or in this case, yes, you have to pay in 110%. So he would have paid in 330. He was penalty proof, even though he owed millions and millions in tax. He was fine. And then the next year, his income went back down to the million. Poor him, right? Went all the way back down. And so in that case, we wouldn't look to the prior year where he paid millions and millions. We would just look to that current year that says, oh, you know what? He's going to make the same million. He's going to owe 300,000. And in that case, you just have to pay in 90% of what your current year tax is going to be. So in that case, he never had to make estimated payments in the millions and millions, because in one year we could use the prior year to get him penalty proof, and then the next year we could use the current year to get him penalty proof. So then people that are self-employed, they pay both the employer's and the employee's portion of employment taxes. We talked about that, and those get paid on the personal tax return. So sometimes people think that they've got to pay those separately somehow, but when you're self-employed, your income tax and employment taxes all get assessed on your individual tax return. There's no separate returns you have to file for that. And there's penalties for not paying estimated payments. It's really more like an interest. The IRS charges interest for people that don't make those. I think the interest rate right now is 3%. It goes up and down kind of with interest rates. Right now, interest rates are pretty low. So it usually fluctuates between 3 and 6% is that interest rate on those. Okay, sales taxes. Sales taxes are the absolute worst tax in the world. They're administered by the state, so you have to pay them to the state. A sales tax account can be obtained when registering a business with the state, which people do inadvertently. They think they answer the question yes when they set up their business, and then the state starts sending them notices and letters saying, hey, you need to file your sales tax. And people say, no, I don't have any sales tax. And then they keep sending them, and then they eventually send them a bill for $1,000 in the mail because they say, because they're required to be filed. And I asked the state that before. I said, why are you sending people a bill? People pay those things. They get a bill in the mail, like, oh, I guess I owe tax, and they pay them. And they say, well, we're trying to get people's attention. I'm like, yeah, but they're paying those, and they don't need to. So anyway, be careful when registering a business. If you answer the questions that you are subject to sales tax, make sure you really are, because sales tax and employment taxes, that's another one people register for when they set up a business. Those all have to be filed with the state. Sales taxes could be monthly, quarterly, or annually, depending on where the state puts you. Employment taxes have to all be filed quarterly. Yeah.
How do you find out if you made that mistake?
The state will send you.
They keep sending me stuff, but I don't know why they're sending it to me.
So if you look on the letter you get from the state, it will have an account number on it. If that account number ends in STC, that's a sales tax account. If it ends in WTH, that's a withholding account. I think I did that right, WTH. That means something else in some circles, but that's a withholding account. If it ends in IIT, that's your individual income tax account. So that's how you can tell really easily what they're sending you a notice for, is by looking at whatever account number they're on. And they have a bunch of other ones, but those are the 3 most common ones.
Okay.
Yeah.
So selling services and sales tax. How do you determine you should really charge sales tax if you're selling services?
In Utah, services are not taxable at this point. So it depends on the service. What kind of type of service?
So what's the software services?
Oh, software as a service, a SaaS. That is sales taxable. Yeah, and the state has guides, or you can call them and say, hey, this is what I'm doing. Am I subject to sales tax?
So let's say you're a global provider, it's a cloud services, something you run on the cloud, right? That is sales tax.
Probably, yeah. Most of the stuff we do.
Is it because it's more product? They're buying you products, even though it's a service, it's a product service.
Right.
Right.
Yeah. It's kind of, if you think about it, back before software as a service and all the internet and all that sort of stuff, you'd have to go down to Costco and buy your copy of QuickBooks or your copy of TurboTax, or you'd physically have to go and buy them, which was subject to sales tax. So they treat that the same. So even though it's now converted and it's completely electronic and digital and all that sort of stuff, they still see it as a product, because that's how it started out, was as a product.
Okay. And then one more quick question. When do you determine that you should get the sales tax registered in the other states outside of Utah? I mean, let's say you do business with it, but it's not like every day, or it's not as often. Like, is there a threshold number or whatever,
Yeah. It used to be, well, it's fairly straightforward now. So there used to be a thing, and there still is, it was called Nexus. And back in the 90s, there was a Supreme Court, 80 or 90, there was a Supreme Court case that it was Quill, and Quill provided, they would send catalogs all over the US, and these catalogs would advertise business things, right? And so you could go to your Quill catalog and you could buy things. And it went all the way to the Supreme Court, because the states were saying they're sending catalogs into our state and they're marketing to our people and they're not charging sales tax, and they should be. And the Supreme Court at that time, the threshold was that you had to have a physical presence in the state. You had to have employees in the state. You had to have property in the state. You had to have some kind of physical presence in that state. And they said, Quill doesn't have any physical presence in the state. They're just sending catalogs. They have no nexus. You cannot charge sales tax. You cannot require them to charge sales tax. And that was the standard for years and years and years. And then 2 years ago, there was another Supreme Court case, and this was Wayfair, again, supplying office supplies and things like that online, and they were selling all over the US and everywhere else. And the states again came and attacked it and said, this is not fair, we're in a different era, we're in a different time, they should be charging sales tax. And at this time, the Supreme Court came up with what was called economic nexus. So they said this whole idea of having physical presence in a state is now out. We're now looking at physical or economic nexus, and each state has set their own level for economic nexus. So if you Googled economic nexus by state, there'd be tons of things that would come up. The general threshold out there is, I'm trying to remember what the numbers are. I want to say, I can't remember off the top of my head. It's like 100,000 transactions or $100,000 or something like that. There's both a
In a year or?
in a year, yeah. There's both a dollar transaction amount and a number transaction amount. So if you go over that transaction amount in the state, you trigger nexus, and now you're required to file sales tax in that state.
So there is actually like a golden rule, the exact numbers.
Yeah,
right?
yeah, yeah. Each state has come up with that. So yeah, if you Google economic nexus by state, it will come up with every state. There's really good websites out there. There's Avalara, that's a good one. TaxJar is another one. These are companies that work with companies to file sales taxes in every state and every jurisdiction. I had a client that leased pickup trucks all over the US, and so they worked with Avalara because when you lease a pickup truck, you get charged sales tax. I think Ohio is the worst. In Utah, it's nice. We file one sales tax return with the state, and then the state sends that money to the counties and cities where it belongs. Ohio doesn't do that. If you are in 20 different Ohio cities, you're going to file 20 different Ohio sales taxes. It's
Very
ridiculous.
convenient. Right?
Yeah.
So what was the term again? Economy?
Economic nexus, or
Nexus.
economic nexus by state. Yeah.
Sorry, this one's a little behind, but they're asking about estimated tax payments. Where do they pay them as a Schedule C? Where do they go to do that?
They the easiest way to do it is Google Pay IRS online. It will come up with a website where you can pay, it'll say either a direct debit or a credit card. They'll charge fees if you use the credit card, so usually you use the direct payment. You click on there and then you tell it what you're paying, and you select that you're paying estimated tax payments. You pick the tax year, and then the next screen goes through an identity verification, and you can pay it online there. You can also get set up with EFTPS. It's the Electronic Federal Taxpayer System. Something like EFTPS is what you Google there. You can make payments that way. You can also, it's a 1040 ES. So if you looked up the instructions to 1040 ES, it would have the address of where you could send those in. So there's really 3 ways to pay it. You can pay online directly with the IRS, you can pay through EFTPS, or you can send in a physical check with a coupon and pay it that way.
Then we had one more question. I think maybe you'll get to this, but someone's asking about the Employee Retention Credit Form 7200 from the CARES Act. Does it need to get paid back to the IRS, or is it taxed?
That's a good question. Yeah, I don't have that in
That's
slides.
kind of a new thing, so I don't know.
Yeah, that is, and they just changed that over. It should just be a credit. Yeah, I'd have to look at that. I'm not as up on that one. We're just barely getting into that one for now. So yeah. Unfortunately, I don't know as well. Okay, so sales tax vary by county, city, and then you must know the sales tax rate of where the sale is sourced. So if your location is here in Sandy, you need to know the sales tax rate of Sandy, because every city has different sales tax rates, and there's different sales tax rates based on what you do. If you go up to Park City and you have a hotel, then you have a transient tax that gets added to your sales taxes and things like that. So, and there's a huge graph, a huge thing. If you Google Utah sales tax, there's they update them quarterly, the sales tax rates, and there's an entire thing that goes through every city and what the sales tax rate of every city is for that quarter. Payroll taxes are administered by federal government and the federal government and the state. Payroll taxes are required to be filed quarterly, And there's an entire small business employer tax withholding workshop that's done here at the Small Business Development Center. So it's an entire day. We'd spend an entire day going through payroll taxes there. Can be complicated. Okay, so this is our last slide here. So other items to consider. So W-9 from vendors to issue 1099 forms. So if you have a bunch of vendors that you work with, anybody you pay services more than $600 during the year, you need to 1099 them. So you get a W-9 from them, so you know how to issue that 1099. There's retirement account options. There's SEP plans and IRAs and all sorts of things that you can do retirement-wise. Hiring your children. If you have children under the age of 18, there's some significant benefits for hiring children. They don't, if you pay them less than the standard deduction, which is around $12,000, they're not required to file a tax return or pay any tax. And so it's a good way for businesses to get deductions. Now, that being said, you have to hire them the right way. On the YouTube channel, I recorded a video for this. So we'll be releasing that in the next few weeks. But you have to make sure that you're paying them a reasonable salary. You can't bring in your 10-year-old to do shredding and pay him $100 an hour. That's not gonna work. I say that because I have my 11-year-old that does shredding, and I should probably pay her something. But yeah, I do have a 17-year-old son who is really good. He records all of my YouTube videos and helps me with all of my marketing, and he does get paid like $15 an hour because it's pretty specialized. What he's done a really good job with what he does. So my 14-year-old boy, I'm still trying to figure out what to do. So anyway, hiring children can be good. It's better if you're a partnership or a sole proprietor, single member LLC. When you become an SCorp, you have to pay employment taxes on them. But a partnership or a sole proprietor, you don't even have to pay employment taxes on what you pay them. It's completely zero tax, which is great. Miler expense tracking apps, we talked about those a bit. The TripLog is one I use, MileIQ. There's a mileage expense log. Biz expense tracker and Expensify are those. And then just another thing on tax updates on the YouTube channel there. Yeah.
Where would you post on hiring your children if it was a single member LLC? Would it be under salary, or where would you put it?
So when you do that, you do have to do all the employment tax returns quarterly. You have to issue them a W-2 and all that.
I'm talking about if you're
on the return. Yeah, and then it goes as salary.
Yeah,
sole proprietor. It would go on your Schedule C as wages.
Wages.
A wage expense. Yep.
Do you know if any of these trackers, for one of the companies, we're gonna start traveling quite a bit, buying companies in California and Texas. So we'll be going there quite a bit to get it up and running. So I'm assuming any of that travel is expensive, but do any of these, like your business expense tracker, do they have forms in there for travel? The airlines that travel to and from the airports, all that stuff?
I don't think, no, those are more just keeping track of expenses, so that they can help keep track of the expenses that you have during those trips and things like that. But yeah, I mean, you might want to just come with a form for something like that.
Yeah, gotcha. Okay, that's what I do now.
Yeah.
Hire children, the maximum age is 18 and below. Do you have minimum age? Usually temple start like movies, what, 2-3 years old? Do we have a minimum age limitation?
Yeah, you just want to be careful that they can do something, because as what you're going to look at with that is, and I guess you could get into child labor laws, which I don't know as well either, but they need to be doing something that they can do. So if they're like 2 or 3, it's going to be awful hard for them to be doing hardly anything for the business. So for like me, I have my 11-year-old daughter who can basically do the shredding. So there's a really narrow window. And you can hire people older than 18 in your business, obviously. You can hire children. It's just when they're over 18, you have to pay the employment taxes for them. Under 18, you don't have to pay the employment taxes if you're hiring them in a partnership that's owned by a husband and wife or in a sole proprietorship. But you just have to make sure that the job that they're doing and the amount that they're getting paid match up and it makes sense.
Thank you.
Doing the K-1s, in the past, we've always, hired, the preparer to do it. And the cost is crazy, especially if it's a startup company that has very little, income or expenses. And is that something that could be done online and then brought to our accountant to, bring into our personal taxes, or does it not work that way?
Yeah, you should be able to. I think TurboTax might have a partnership, or,
We usually don't go to that level for our personals because we have a lot of intricate stuff. So
yeah, well, I'm saying, yeah, if you're saying for the business, like
Oh.
TurboTax should have a partnership module that you could prepare a partnership return in there. Or, I'm not sure, I'm sure there are some online ones.
Okay.
Yeah, we just have one more question on mine.
Uh-huh.
They're asking, for reporting revenue on your Schedule C, does your 1099 totals have to match your revenue? You could do business under 600 threshold, which might cause a variance.
Yeah, so with that, the IRS only cares if the amount reported on your Schedule C is less than the 1099s you received. If that happens, you're gonna get a notice from the IRS with them saying, hey, what's going on? If you report more income than the 1099s you received, the IRS isn't gonna bother you at all. That happens to me every year because I have some people that pay me less than 600. I also do a lot of some individual returns that aren't required to 1099 me. So people will naturally do work that they're not required to get 1099 for. If as long as the income you report on your Schedule C is more than the 1099s you receive, equal to or more than, the IRS won't bother you. It's if it goes the other way, you'll see a notice for sure.
Cool, thank you.
All right, guys. All right, this is a wrap. Thanks for being here and tuning in online, and we'll see you next time.